Hello there, my name is Martin. I'm a chartered accountant and tax advisor, and in today's video, we're going to be going through the accountant's guide to becoming and keeping. Hello, my name is Martin. I'm a chartered accountant and tax advisor, and today we're going to be looking at your accountant's guide to better money habits, 9 tips to make you rich. And these tips would have been taken from my experience over the last 10 years working in my own practice, as well as the 10 years before that working in industry. These are very practical and I hope you get some use out of them. So today I wanted to discuss what I would have seen over the last number of years. Like managing money is quite difficult at the best of times, and not knowing what to do when you have funds available, or a system that you would have in place to manage funds as money comes in and goes out. It's a bit like a heart. I do imagine that money comes in, which is the heart expanding, and then when the heart contracts, money goes out, and it's the money going out part of it, which is the probably bleeding, the bleeding part of it. No one wants to bleed money. No one wants to throw money away, and the purpose of today's video is to go through some 9 tips in order for you to make sure that you keep money in your heart a little bit longer. The first tip is going to be pay yourself, which is inspired by Rich Dad, Poor Dad, and also the profit first mentality. It's a very simple concept. The concept is when you get paid your wages, or if you get paid from a job, that you allocate the profit section of that and put that aside before any other bill is paid. Very, very simple in theory, very, very simple in practice. So if you get paid 3,000 euros, if that comes in the form of work that you've done, or as your pay slip, you allocate a percentage of that away, and that percentage should be rock solid every week, every month. The same amount should be put aside and put into a savings account. And what you put across into the savings account we'll speak about that in future tips as we go further down the list. But that becomes the basis of your wealth accumulation, is primarily the regular saving of money that you are being paid. And in order to do this, you need to allocate it and put it into a separate bank account, a bank account that you don't go near, that you can't be touching. This isn't a savings account that you're going to save up to spend enough money, save up enough money that you're then going to spend on the holidays next week, or you're going to book your flights to New York, or you want to send the kids to the Gaeltacht. It's nothing like that. This is for long-term wealth creation. So start small. Don't put in 50% of the wages that you've been paid, because you won't be able to maintain it, and then you'll have to dip into it. Make sure it's manageable, and if possible, that it's not going to affect your day-to-day living. The next part is to separate money like a business. And so when you are in business, money you are paid usually comes in with VAT. So a sale is made, and it would be the net price, and it'd be the VAT amount. The VAT is not owned by the business. The VAT is being held by the business owner, and it's going to be given back to revenue when the VAT return is going to be filed. We're only cash collection agencies. That's all we're doing, business owners, when it comes to VAT. And a bit like that, when you receive money in, you need to allocate the money that you want to spend to whatever the purpose is. So money will come in the form of your wages. You've allocated the profit part of it, and you've put that aside. But what about everything else? How much have you allocated for the household budget? How much do you need to meet your mortgage repayment or your rent? How much do you need to put aside for the car service that you have next month? So there's a whole load of buckets that needs to be filled. And when these buckets are filled, this is what you pay these bills out of. And it helps that anything is left over, then that really becomes your money. You should have a bucket as well, for a fun bucket, so that you can spend money as you wish on stuff that you may or may not want, but something that makes you happy. Tip number 3 is know where your money goes. And this is a very, very important part. Managing, or as money leaves your bank account, you can see it leaving, but tracking exactly what you're spending your money on is very, very important. Because if you're noticing trends, because we're creatures of habit, that if we're stopping at the same shop and buying the same croissant and coffee each morning, very quickly that becomes a habit, and that habit becomes very, very difficult to break. And when you know that you are spending this much money on these items, or you're doing this on a regular basis, at least then you know where the money is going. Not knowing where your money is going and just looking at the bottom figure at the bottom of your bank account, that's no way to know exactly what you're spending your money on. So take the time and go through it, map out where your money is being spent, and it'll give you a good picture of where you're what you're spending your money on and what you shouldn't be spending your money on. The next part is to build an emergency fund, and this is key. And this goes back to tip number one, where you're putting and allocating a percentage of your money aside. You're paying yourself first. And the reason why this is important, because this €1,000 becomes, this is your emergency fund. This is your financial safety belt. So if something was to happen in the morning, that you can actually dip into this and go and use this money to pay whatever emergencies that come across. So start small of something like €1,000 and take your time to build this up. So this is separate to your savings, but you can go hand in hand. You can use the savings part of it until you get to your €1,000, and then that becomes your safety belt or your emergency fund, and then you can continue on keeping this separate. But you really want to get to that €1,000, and then after the €1,000 is met, you need to push that out, or you should push that out to about 3 to 6 months of operating expenses in the house. So if you know that on average you're spending 2,000 a month on looking after your household, you know that, okay, you need 2, I need 4, I need 6, I need 6 grand saved to operate our house for 3 months. So if something was to happen in the morning, or we lost our jobs, or whatever foreseeable circumstances come your way, that you have enough money put aside in order to meet those obligations. And again, you don't dip into this fund willy-nilly. You don't go into this fund because you need a new phone or you're saving for Christmas. This becomes bread and butter routine, that when the money has come in, you're allocating it accordingly over, and you're building that up to that 6,000 or 8 grand or whatever the limit is that you're comfortable with. And then when that happens, then you're set. It gives yourself that stability as well. Tip number 5 is stop trying to impress people. And the biggest mistake that people are making is buying stuff they can't afford to impress people that they don't even like. And this is a clear example of that people will, and we're all victims of this. We want the newest iPhone, we want the newest car, we want the nice clothes, we want to live in the fancy house. But sometimes we can't afford all these things, and living within our means is something that is not seen as being acceptable a lot of time in society now. But knowing where your limitations are, that you can't actually overstretch yourself, because that leads you down a road where you do not want to be. So you're borrowing short term in order to buy something that you're going to be paying over the short to medium term. You're overextending yourself compared to what you are earning. Like, if you can't afford to buy it from your debit card, definitely don't buy it from your credit card. Tip number 6 is make money work for you. And this is inspired by Rich Dad, Poor Dad. This point means that when you have your €1,000 emergency fund, you have your 6 months, 3 to 6 months of operating expenses for the house saved, you're going to continue to save. So why not put that additional money to work? So you're going to you can invest this then in stocks, shares, you can start saving towards second property. It sort of helps you, once your needs are met in the short to medium term, you can start start putting funds to work for the long term. So investing in even if you were putting money into prize bonds, whatever you wanted to be doing, that you're allocating money into something that is beyond the savings that you're putting in place. So you have your money saved, you're putting additional funds into, as I mentioned there, you're saving it in a long-term deposit account. You're putting money into a pension, perhaps. You're putting money into your children's education. Whichever way you're doing this is to make that money work for you into the future. And you can start. So if you're investing, for argument's sake, €500 a month, you continue to invest that every single month, and the returns will start to come if you're playing the long game, of course. Tip number 7 is to avoid debt. And I mentioned this earlier, like buying stuff with credit cards, to make sure that and making sure that you can make the minimum payment, but you're paying that minimum payment for 5 years or 3 years, and the interest rates are so high. So you're buying something for €100, you're paying the minimum payment on it. By the time you have it paid off, it's costing you nearly 250, if not €300. It's not an ideal way to use your money. You can use your money any way you wish, but that's not the most efficient way of managing your money. The only person who's getting money off this is the credit card companies. And if they're charging you 20%, 22% interest on these bills, and you're only paying the minimum payments, they are making money hand over fist, and you're paying for it. So you might have a new jacket that you bought it with your credit card, but if you were to count or Alec, if that jacket costs €500 today, but you bought it on your credit card and you'll be paying that over the next number of years, that jacket might have actually cost you up on €600 by the time you're finished paying for it, if you're only paying the minimum payments. So just be aware of not having debt, and that debt also comes in the form of finance on cars or short-term payments you're making. If you're buying something online, there's an awful lot of companies now who will offer you the option to pay it over a certain amount of time. But once you go over 6 months, it's interest free up to 6 months, but after 6 months, they'll start to charge you interest on that. So getting you to buy something quickly and offering good credit terms is one way of making the sale. But if you can't meet that obligation, if you can't pay this off in 6 months, consider buying something else. Number 8 is not to rely on just one income stream. And this is very, 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 very common now in 2025, where business people they'll work full time and they'll have a second income coming in. And that second income is subsidizing the household. So they're making their POE money, and that's paying towards the rent, and it's paying towards the mortgage, and it's looking after the kids and the house, etc. But the additional, they have a little bit of a passion and they want to do something on the side, and that's giving them fulfillment that way, and it's also bringing in some money. And even if it's only €600 or €700 a month that's coming in, that €600 or €700 has a purpose as well, because that can be used for the people, or for the person who brought that in. They can spend that on things that they might necessarily be able to afford from their job. Just to be aware on that side of it is that you're registered for taxes, and you're putting aside enough money to pay the taxes on any additional income that you are earning. But it is a good thing to do, because if you have a second income coming in and you are advertising, and you're using your mobile phone, there's a lot more expenses that you can write off against that trade that would have been payable out of your PAYE income after you've paid all your taxes on that. And point number 9 is to surround yourself with financially smart people. Make sure you aren't in a crowd that everybody is. If all your friends are buying the latest fashion and they are overstretching their credit cards, and they're quite happy to say this to you, more than likely the reason why you're in that situation is from the people, your friends. I'm not saying to find new friends, but I'm saying just be a little bit more smart when it comes to who you take your advice from, and the crowds that you want to fall into. So follow people who are good with money. Read books that will you'll be able to manage your money a little bit better, and of course, have friends for the right reasons, and not for just the reasons that I've mentioned there. So that brings me to the end of this video. I hope you got something out of it. If there was any tips that I've missed, or anything else that you would have considered being a tip, please just let me know in the comments below. And until the next time we're talking, you take care of yourself.